the liquidity crisis and the bank failures that are happening going to affect the housing industry? Whether you're an investor or real estate agent, what I'm going to tell you will apply either way. The short answer first, then I'll go into the detail and explain it. I don't believe that banks going out of business or the fact that they are short on liquidity will adversely affect the housing industry as much as other industries. Everybody will be affected, but not to the same level in our industry. And here's why. In fact, we should dig a little deeper and tell you a little bit about the liquidity crisis. What's happening is the banks have had a run on their deposits. So a lot of depositors have just woken up to the fact, as a result of the Silicon Valley Bank issue, they've woken up to the fact that only $250,000 is guaranteed if you've got it in a bank. $500,000 if you're a couple, $250,000 or an individual. And a lot of people who put their money in banks as a safe harbor woke up to realize after Silicon Valley Bank that they had way more than that in various accounts that collectively will merge into one. It's not $250,000 per account, it's $250,000 for you per bank. So short of having to spread around, if you had $1 million cash, for example, spread it around to 4 different banks, $250,000 each, a lot of people just stuck it in one bank and 3 or 4 as savings and different things that amalgamate to over $250,000. And so they realized that they could lose their money. In addition to that, they woke up to the fact that banks are paying 0.5%, maybe 1% interest in the best cases. The banks, all they're doing is taking that 0.5% money that they're borrowing from you. Essentially, that's what it is you're loaning them your money, and they're turning around and buying treasuries, United States Treasury bills, whether they're bonds, bills, or notes. Okay, so, and by the way, a bond is 20 to 30 years. That's the old, Series EE bonds that people bought, and grandfathers, grandmothers buy it for their grandkids to go to college 20, 30 years from now. Those can't be transferred. They're in a particular name and they're stuck for the entire amount of time. You can sell them early and discount them, but you can't trade them like you can anything else. T-notes, treasury notes, 2 to 10 years in duration. And this is where the housing industry comes in, because most of the pricing for mortgages in our industry, in the housing industry, is based on the 10-year T-bill, or 10-year treasury note, actually is the technical term. And finally, the T-bills themselves are anywhere from 3.5 to 4, up to months to a year. So basically 3 to 12 months, essentially duration. We've got a situation now where the notes, the 2 to 10 years, are paying less. Their market rate is less than something for 3, 4, 5, 6 months. For example, today, a 10-year T-bill yields 3.52%, and a 91-day note, or a T-bill, will generate 5.14%. So in other words, collectively, investors assume it's safer to do something very short term with the government, 90 days, than it is to do 10 years. Fortunately, the 10 years is the basis upon which we get all of our mortgage rates. But going back to the liquidity crisis, what's happened is people have realized they're not getting much, and they're giving the money to the bank as a loan, who's turning around and taking and making 10 times the amount of interest from the U.S. government that they're getting from Bank of America. Let's say, for example, I apologize to Bank of America people, because I tend to pick on B of A because I bank there. But people have now realized I can go get that 5%, 5.14%, 90-day treasury certificate, and I can do it direct through Treasury Direct. I don't have to go to a bank and do it. I don't have to have a broker do it. I can just do it online myself, save all the fees, and I'm going to get 5+% versus 0.5% from Bank of America, or 9/10 or whatever the current rate is. So one of it is you can make a lot more. Number two is it's safe. It's a lot safer than a bank. Bank has this FDIC window, $250,000. And when you invest in treasuries, in any of the bonds, bills, or notes, you're 100% guaranteed to whatever dollar amount. It's guaranteed by what they call the good faith and credit of the United States government. And so you could put $1 million into treasuries and you'll be guaranteed all of it. So why would you put $250 or $500 in Bank of America only to have half of it being guaranteed by the government and risk the other half and get 1/10 the interest that you could get in a T-bill? So there's a flight from bank deposits over to the government side, to the treasuries, because of these factors. And there is a third factor, and it's a rumor that's been floating around for the last 3 or 4 days, but I don't know if it's true or not. A lot of times, some of the sources, you see these rumors they seem to have a leg up, a few days advance notice, but there is a potential bill. It's not formalized yet, but there is an urge that the government could, and specifically the president, could put a window or a moratorium, is what they're calling it, on you taking your money out of banks. To keep the banks from melting down, they may say, listen, you can't get your cash out of the bank for the next 180 days. And so, when this becomes more broad knowledge, and once they're actually considering, it gets to the Wall Street Journal and all these things, you're going to see a massive run on the bank, and all the money is going to go over to the treasuries. The more money that goes over to the treasuries, the less the government has to pay, which is going to drop the rates. The lowest rate right now is the 10-year, not the 30-year, not the 90-day. And the way that you calculate a mortgage payment is roughly as follows. You take the current rate, the 10-year, and you can look this up on what's called the FRED chart, F-R-E-D, Federal Reserve of Kansas City. You look at the 10-year note value, or the yield that they're paying for that. And like I said, today it's literally 3.52%. You can add to that number, whatever that is on that day, add about 2.2%, and that'll give you your 30-year fixed mortgage. So that's how that thing works. So today you can get a fix for around 5.7 approximately percent interest. Now there are some people, some mortgage lenders that are going to do it cheaper and that type of thing, but you're going to see a lot of people rely more on treasuries than they are on bank deposits in order to fund a mortgage. And so we happen to actually be in the catbird seat right now, as far as I'm concerned. And that's why, in spite of all of these interest rates going up, and keep in mind, the Fed funds rate, which used to be called like the prime rate, the best rate that the banks get on overnight lending is about 5.25% now. 1 year ago, it was a 0.5%. So once again, that's grown by 10x. Shame on the banks for not raising the interest they're paying, because they're still paying sub 1%. Some of them are paying more, but generally it's in that kind of range. And the banks have been making money hand over fist, basically by being a bookie. They're taking your money in, they're loaning it to the government vis-a-vis treasury securities, and they're making 10 times what they were paying you. Those of you who have a savings account or a checking account where they pay no interest, they're taking that money and loaning it to the government vis-a-vis a treasury security. Very safe. And, it's at that level. Now, the problem that those guys run into is they don't have enough liquidity. They don't have enough cash in the bank, that if everybody comes and wants their money out today, they don't have enough to do that. And so what they got to do is take those treasuries that they bought, and they have to sell them at a discount. And so that creates a loss on their balance sheet. So let's say, for example, they invested $1 billion on a 90-day or something, or even 180-day, where they could get 5%. And if they've given that cash to the government, if they need that $1 billion back to pay Joe, Sam, the Joneses, the Smiths, everybody who comes to the window and says, I want my money back out, they got to take that 5% asset they bought, and they're going to have to discount it to 2, 3, or 4 to find some other bank that will cash them out of that, or some other hedge fund, or some other financial advisor type thing. That's going to create a big loss on the profit sheets of the banks. It's going to basically put them out of business. And that's why banks are failing, is literally because this is like a 1930s type run on the banks. And it's happening all over. I just saw a thing yesterday that said there's over 770 banks that have had a significant chunk of their deposits removed by their lenders, those who put money in these banks. And most of that money, like I said, is going to the government. And when it goes to the government, pay less rates, they'll pay less interest, and that's going to drive down that 10-year note, which is going to drive down mortgages. So I think we're safe in the housing industry for whatever reason. Even though they clobbered the housing industry by raising these interest rates, they are also protecting it by making it probably one of the more stable assets. That's why housing in a recession is a good place to be. Hey, thank you for watching. If you get a minute, I would love to hear your comments about what you think of these videos. Feel free also to put in any topics down here in the comments section, things that you'd like to hear me discuss. Any questions you want, go ahead and put in here. We'll make sure we get a video on it when we get time. And as always, please like and subscribe. Hit that ring the bell button as well to get notified every time there is a new video. Thanks a lot, everybody.